Hello and welcome. My name is Sergiu Hurtescu, a certified financial planning professional based in Richmond Hill, Ontario. Some of you may have seen some of my previous videos, and I'm wearing these headsets today because I'm trying out a new setup in my home video shooting environment, which is not professional in any way, but I've got a Yeti mic and I just need to plug these earphones in so I can hear the sound that it's actually coming through, so I don't have to record this over and over again. Anyway, besides that, thanks for joining. I want to say that in my practice, I work with so many of you who share the same vision as me: living, working, or retiring abroad, partially or permanently. And I know that that can change. Whether you're a snowbird or a permanent expat, the journey is still filled with three critical challenges: the financial, the logistical, and the emotional. Now, the emotional came out quite a lot last week. I think that we touched a nerve with the Canadian departure tax, the infamous deemed disposition. The comments section exploded, and not just with, questions and so on, but some confusion, some frustration, even some anger. And I understand. But here on this channel, what I'd like to focus on is the specific rules and not rhetoric. So my goal is to be your source for accurate information and logistics, not any other type of political debate or anything like that. So let's start a new chapter. Today, I'm launching a new playlist because I've thought about it. Maybe these topics are too big and we need to chunk them down. And I'm thinking of calling this new playlist Foundational Topics, which will be a series of bite-sized videos tackling one key rule at a time. And from this topic today, you'll see that even that can become complicated because there's just so many things to talk about. And one foundation piece needs another foundation piece below it to be understood fully. So I'll try my best. My lighting keeps on changing on me. Sorry about that. And today's topic is going to be simple. Today's topic is going to be about the tax on interest income for Canadian expats. Now, before we do dive in, a quick but necessary reminder: while I am a certified financial planner, on this YouTube video is for educational purposes only. For personalized cross-border tax advice, please seek consultation with a qualified professional who understands your unique situation. Now, I thought we'd use an avatar for this scenario. We're going to call him Bob. I'm going to call him Bob, obviously, because it's my video, so I've decided to call him Bob. Next week, maybe we'll call him something else. Now, Bob has successfully moved to Spain, and he is a non-resident for tax purposes. He sold his home, but kept a rental property and maintained his non-registered investment accounts in Canada at a wealth management firm. And here's what Bob's investments are. He has $800,000 in a medium risk discretionary portfolio. That's another topic we'll talk about and probably a future video, but a discretionary portfolio simply means that Bob doesn't have to make the decisions on how to invest. It's handed over to the wealth management firm, and they will automatically rebalance his portfolio to stay within that medium risk tolerance. Now, he's also set aside some cash, $50,000, in a high interest savings account, HISAs we call them, HISAs, and that's there for liquidity. And he's got another $250,000 spread across a GIC ladder for more stable income and higher interest rates. Now, GIC ladder, another foundational piece we'll talk about, but basically it's taking a certain amount of money, dividing it by 5, so $250,000 divided into 5, $50,000 each. And that first $50,000 would be invested in a 1-year GIC that's locked in. The second $50,000 will be invested in a 2-year GIC, the third $50,000 in a 3-year GIC, and so on. And the idea is that usually the longer the GIC, not always, the longer the term, you get a better interest rate. And every year, you will know that 1/5 of that is going to mature so that Bob can decide whether he needs that money to go into his HISA or he can get into another GIC. Anyway, this is not here nor there. It's basically letting you know how he's developed this plan with his financial planning professional so that there is liquidity if he needs it in the short term in the $50,000 in the high interest savings account, so that he doesn't have to access anything from his $800,000 non-registered account in case the market is taking a dip when he actually needs the money. And then he's also got $50,000 coming up maturing every single year. Now, here's the question that decides Bob's Canadian tax bill. How does Canada tax the interest he earns from his Canadian GICs, his high interest savings account, and also the interest distribution that might come from his managed discretionary portfolio? And surprisingly, the simple answer, and I hope that people will be happy about this and the comments won't explode too much, but is that the most common scenarios for interest payment for a non-resident is zero tax. There's no Canadian withholding tax on this interest. Sorry, I want to be clear. There's no withholding tax from the Canadian side of the equation. Okay? So if there's interest income, normally if you were in Canada and it was a non-registered account or a GIC, you would have to tell that to the CRA when you're doing your taxes, and you pay tax on that interest. And it's not taxed very favorably in Canada. It's like taxed as if it's income. But if you are a non-resident and your wealth management company or bank knows you're a non-resident, you'll be issued an NR4 and there'll be zero tax to pay on the interest. This is one of the most favorable rules in Canadian non-resident taxation. So while the default tax rate for Canadian sourced passive income is typically 25%, and this is under part, how do I say this, X111 or 13, part 13 withholding tax, that's the rule. There is a powerful exemption in the Income Tax Act itself. The simple rule is that interest paid at arm's length is exempt, 0% withholding under Canadian domestic tax law, meaning this 0% rate applies regardless of whether Bob moved to a tax treaty country like Spain or a non-tax treaty country. Tax treaties only become relevant when we look at dividends or other types of passive income. So this exemption works for Bob's entire interest stream. The interest from his HISA, exempt. Interest from his GICs, exempt. Even the interest that flowed through his managed portfolio, his discretionary portfolio at the wealth management firm, exempt. The law actually allows this specific type of income of interest to flow through the investment structure, keeping its tax exempt status just like the GIC. So when Bob receives this interest, he won't get the T5 slips that he would normally get as a Canadian resident. He will receive instead an NR4 slip that shows the gross interest amount and confirms the $0 withholding tax, often used with the tax code in the little box there of 61, which refers to arm's length interest payment. Now, Bob's job then is to then take that NR4 slip and report the income on his Spanish tax return. Now, to be complete, there are two primary reasons you would pay tax on Canadian interest, actually. So while I did say that interest is tax exempt, if you are the payer and you pay interest, if you're the person paying interest, or a family member of yours pays interest to a non-resident family member or to a related corporate entity, then it's taxable. With this under the Part 13, the general tax withholding is 25%, unless of course it's a tax treaty country, then it could be lower. The other way is that if the interest is tied to the performance of a business, like being calculated based on profits or revenue, and this is seen as profit sharing and not traditional interest. The interest rules are simple, but what about the rest of Bob's portfolio? What about the Canadian dividends that this portfolio earns? Remember, I said the tax treaty doesn't matter for interest, but it makes a huge difference for dividends. So next week, I'll dive into how the 15% tax treaty rate applies to dividends, and why you might be paying Canadian tax on those distributions. If you want to know how the rest of Bob's portfolio is taxed, then make sure you don't miss next week's video. Please feel free to share your non-resident experiences or drop your follow-up questions in the comments below. Before I sign off, I do want to say that during my research into this topic, I did come across a couple of, I think, valuable links. You be the judge. I'll put them in the description below. And also, I'll put in the description below the topic last week that caused up all the comments and the emotions on deemed disposition, the departure tax. That was a lively topic for a short video. But if you'd like, take a look in the comments, and you'll find a link also to the CRA website that lists all of the tax treaty countries. You can look in there to see if the country that you're looking at is in that list. And also, there is a pretty handy tool that the CRA developed that is a CRA non-resident tax calculator, where you can actually go and select the country you're in or planning to go to, add any income from Canadian source, whether it's dividends, capital gains, interest, whatever, and then see how much the tax treaty is and what the potential withholding tax is on it. These are just tools. In the end, let me add that disclaimer again. It's really, really important that you don't just take any information you see on YouTube as your specific advice to you, whether that's from me or anybody else. And it's still recommended, highly recommended, that you reach out to a professional, either a certified financial planner, international tax accountant, and talk with them and give them your situation and see where that leads you, because there may be things that are specific to someone else but not to you, and vice versa. Have a wonderful rest of the week, and I look forward to reading all of your comments and replying to as many as I can. Bye-bye.